This video has been prepared to help you revise for question 1 of the FAPS assessment. Question 1 is about using Daybooks and accounting for and monitoring non-current assets. This task is worth 28 marks, which is the most marks out of all of the questions. Based on our students' performance over the past year, this is one of the best performing questions, with our students on average gaining 85% of the available marks. Our overall pass rate for this question is 86%, meaning that 86% of our students pass this question alone. And compared to AAT's published pass rate of 73%, we're generally doing pretty well. According to the AAT specification, the topics tested here are understanding of daybooks, including which daybook to use for various transactions. Also, the advantages and disadvantages of using books of prime entry, which is just another way of referring to the same thing. All aspects of accounting for the purchase and disposal of non-current assets, including entry into non-current asset register and the authorization procedures. Calculation of depreciation and accumulated depreciation using different methods and scenarios, and preparation of either journals or entering the figures into the ledger accounts. General knowledge questions on non-current assets and their effect on the accounts, or linkage to accounting principles, and identification of the effect of errors can also be tested in this question. AAT produce an examiner's report every year, which gives valuable feedback on how all students who've taken this exam have performed. So the strengths in performance include recording the acquisition and depreciation of non-current assets in the non-current asset register, calculating the annual depreciation of a non-current asset using both the straight line and the diminishing balance method, and completing the disposals account where the proceeds are in the form of cash. However, weaknesses include accounting for disposals in the non-current assets register, identifying the effect on the accounts of incorrectly including revenue expenditure in the valuation of a non-current asset, calculating the accumulated depreciation prior to the disposal of a non-current asset. So all of these things that are mentioned, both the strengths and weaknesses, are topics that definitely come up in this question. So this can be really helpful in knowing where to focus your revision. AAT also note that you're advised to ensure that you understand the purpose of the non-current assets register and how the disposal should be recorded, and that you familiarise yourself with working out the accumulated depreciation prior to the disposal once you've worked out the annual depreciation for a particular non-current asset. The use of daybooks is covered in Lesson 3 on Moodle. Now this is covered very extensively at Level 2, so it should be very familiar to you. Traditionally in manual accounting, daybooks, or books of prime entry as they're sometimes known, would be completed by the business prior to entering the transactions into the accounts. As most businesses now use some form of computerized software, the transactions tend to be entered directly, but daybooks can still be produced when needed, so it's very useful to understand the process. The most important daybook to understand is the cash book, as most transactions will go through it. Another topic that should be straightforward is the definition of current and non-current assets. Normally we say that assets are things that the business owns or that have a value to the business. But at Level 3 we need to be a little bit more technical. So current assets are things that the business will hold for less than 1 year. For instance, inventory. So that includes things that the business has bought or made, which will be sold on to customers, and also includes raw materials. Trade receivables, so that's debts that have been run up by credit customers and which are waiting to be collected, and it's assumed that those customers will pay, which is why they're considered to be assets. And there's also the bank account. Now it's an asset so long as there's money in the account. However, if the account is overdrawn, then it would be considered a current liability. With non-current assets, we have a financial reporting standard 102, which gives us a more technical definition. So what that says is that these are things that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and they're expected to be used for more than one accounting period, so more than a year. An entity, in other words a business, can only recognise an asset on their statement of financial position if it is probable that future economic benefits associated with the item will flow to the entity and the cost of the item can be reliably measured. So in other words, the items must be being used within the business to generate income. One of the most important books in the accounts is the cash book, often just called bank. So at the simplest level, if you sell something for cash, including a non-current asset, the bank balance increases. And if you buy something, the bank balance decreases. If you're doing a trial balance or extended trial balance question, watch out if your bank figure is in the credit column, because that means that you're already overdrawn. So work out adjustments carefully, as you'll be starting with a negative number. If you sell a non-current asset, the value of the sale, unless it's a part exchange, we'll come back to that, will be treated as an increase in the bank account, even if the effect of the sale is a loss. Now you should get used to always drawing your bank or cash book as a T account whenever you're trying to work out the entries. And the easiest way to do that is to think about whether money is coming in which case it will be on the debit side, or whether money is going out, in which case it will be on the credit side. Now if you've got a debit balance, it means you have money in the bank. Whereas if you have a credit balance, it means the business is overdrawn. Now what you might find helpful, and you may think this is just so corny, is to draw smiley faces and sad faces when you draw the T account. So on the debit side, you can draw a smiley face to represent money coming in, and if you really want to tie it all up, that's D for delighted face. And on the credit side, you've got a sad face or a crying face. And if that's too corny for you, then just write in or out at the top of your T account, and it will really help when you're trying to work out the entries. The purchase of non-current assets is covered in Lesson 6 on Moodle, so we won't go through it in detail here, but the important things to revise are the difference between capital and revenue expenditure, and that includes what can and can't be included in the capital value of an asset, including assets made or installed by employees of the business. Also revise how to calculate the cost when part exchange is involved, and we will look at an example of that in a minute. How materiality affects the value of the asset. So in other words, has the business set a limit below which they don't record non-current assets in their non-current assets register? How to complete a non-current asset register, and who within the organisation is allowed to authorise capital expenditure. Depreciation is covered in Lesson 7, and it's almost certain that you'll have to calculate depreciation at some point in this exam. Depreciation is an example of the accruals concept, which means that it enables you to spread the full cost of a non-current asset across its useful life. You'll need to know how to calculate depreciation using both of the main methods, which is straight line and diminishing balance. With the straight line method, each full year's depreciation will be the same. You could be given an annual percentage, or you could be given the useful life of the asset in years to enable you to work it out. You may also be given a residual value, and if this is the case, you need to deduct the residual value from the cost price before dividing it by the useful life to work out the annual depreciation charge. Under the diminishing balance method, sometimes called reducing balance, you'll be given a percentage which you apply to the previous year's carrying amount to calculate a full year's depreciation. You may sometimes be given a residual value, but you don't use this in your calculation. It's just there for information, so don't get caught out with that one. Make sure you understand how much depreciation to allocate by checking the policy outlined in the question. There are two possible policies that are likely to come up, and in each case the key is to check the dates carefully. The first one is that a full year's depreciation is applied in the year of acquisition and none in the year of disposal. Now in this case, be very clear when the acquisition took place, when the year-end date is, and when any disposal took place, and work out the years carefully, because a full year will apply even if you only bought the item a day before the end of the year, for instance. The second policy is that depreciation is charged in equal instalments based on each full month that the asset is owned. So this can be a bit more tricky, and it's even more important that you work out the months accurately using scrap paper or even counting on your fingers. Don't be embarrassed, it really works. Work out a full year's depreciation, then divide it by 12 and multiply the number of months that the asset has been owned. Again, look carefully at the dates. Is it the first of the month, in which case a full month will apply, or is it the last day of the month, in which case you don't count that month? Now, be careful here because you shouldn't ever have dates in the middle of a month. It will only ever be a full month. So again, just work out and then double check the number of months to make sure that you're accurate. As well as calculating the depreciation charge, you also need to know how to record it, and that could be in the non-current assets register or in the general ledger, either by creating a journal or entering the figures directly into the T accounts. So the annual depreciation figure is recorded as a debit in the depreciation charge account, because that's the expense, and a credit in the accumulated depreciation account, which acts as a reduction in the asset being the original cost of that asset. The original asset at cost account is not altered, so that always retains the original cost purchase price. Depreciation doesn't affect the cash book or the bank balance of the business, because basically it's just an adjustment. So again, that's the sort of question that could come up to test your understanding. So now we'll have a look at the treatment of the disposal of a non-current asset, because this is something that comes up very frequently in the exam. Now this topic is covered in lesson 8, where there's lots of good examples. So when a non-current asset is no longer needed, it can often be sold or traded in as part exchange against a new model. Its value at the time of sale will be calculated as the original cost minus the accumulated depreciation, which gives you something called the carrying amount. If it's sold or part exchanged for more than this value, a gain will be made, which will be accounted for on the statement of profit and loss as sundry income. If it's sold for less than this value, a loss will be made, which will be shown in the expenses section of the statement of profit and loss. And a disposals account is used to bring together all of these figures, so make sure you understand how the entries. You could be asked to make entries into ledger accounts or draw up a journal to account for the disposal of an asset. The accounts that are involved in that disposal include the non-current asset at cost, the accumulated depreciation, possibly depreciation charge account, possibly the bank, and definitely the disposals account. You might only be given some of these accounts, so it's advisable to work out all the entries on your scrap paper to ensure that all the double entries are covered off. Part exchange is often tested, so make sure you revise what to do with it, and we'll look at an example of that next. Let's work through this example of a part exchange. A business, Accent Limited, is buying a new car for a salesperson with a list price of $26,000 and is part exchanging an old car for $7,500 on the 30th of April XD8. The old car that was part exchanged originally cost $18,000 on the 1st of September XD4, and at the date of disposal the accumulated depreciation totalled $11,671. Now sometimes you'll be asked to calculate that accumulated depreciation. In this case we already have the figure. So what we need to do is calculate the profit or loss on the disposal of the old car, how much needs to be paid from the bank for the purchase of the new car, and then we need to make the accounting entries for the disposal and the acquisition. So let's start with looking at the profit or loss on disposal of the old car. The old car originally cost £18,000. The accumulated depreciation is £11,671. So we work out the difference, which is £6,329, which is the carrying amount, in other words, how much the car is worth in the company's books at the time of disposal. We then look at how much we achieved for the sale of that car, or in this case the part exchange, which is £7,500. So taking the one from the other gives us a surplus of £1,171, which is the profit on disposal of the old vehicle. We can now look at how much extra we'll need to pay for the purchase of the new vehicle. So the cost of the new car is £26,000. The part exchange allowance is £7,500. So take the one from the other, leaving £18,500, which is the amount of cash that's needed to complete the purchase. Now we'll look at the entries into the ledger accounts. Now there are 4 accounts that are affected by these transactions. We have cars at cost, accumulated depreciation, disposals, and the bank account. We can see that in cars at cost, we have a balance brought down on the debit side, which is the value of the car that's been traded in at cost. Now sometimes you'll see a higher figure here, and that would represent other vehicles that the business still owns. We also have a balance in the accumulated depreciation account, which is the amount of depreciation that's been applied to that vehicle. So first of all, we are going to remove those entries from those accounts and move them into the disposals account. So we credit cars at cost with £18,000 and debit the disposals account with that same figure. And so effectively we've now removed the value of the vehicle that's been disposed of from the cars at cost account. We now do the same thing with accumulated depreciation, debit accumulated depreciation, and credit the disposals account. So again, that account has been cleared, and we have the 2 balances in our disposals account. We now add the value of the part exchange, so the amount that we've received for trading in the old vehicle, and this will always go on the credit side even if the money has been received from the bank rather than a part exchange. So £7,500, and the opposite side of this entry goes back into the cars at cost account. Now this is the step that people often get wrong. Because it's been part exchanged, the value of the disposal is going to go towards the purchase of the new vehicle, and that will be recorded in the cars at cost account. We can now balance off the disposals account, and the higher figure is to be found on the credit side. So our new balance will go in on the debit side, and in this case this is a profit because we've sold the car or part exchanged the car for more than its carrying amount, and so the figure will be a profit, and this will be shown as a credit on the statement of profit and loss. So the opposite side of that entry will go directly onto the statement of profit and loss. We can now deal with the remaining entries required for the purchase of the new vehicle. So we've got the £18,500 that we worked out previously, which needs to come from the bank to meet the full cost of the new vehicle, and the other side of that entry will go into the bank account. And again, we've reminded ourselves with our little smiley faces that money going out of the bank will be on the credit side. We can now balance off the cars at cost account, and the balance will be on the credit side, balance carried down, which is the total value of the new vehicle, and that will then become the balance brought down going into the next accounting period. So the full value of the new car is now held in that account as a debit. Now let's look at the non-current assets register. Now this topic is covered in Lesson 9 on Moodle, which includes a very comprehensive worked example. So we're just going to look at some hints and tips. So you might be asked to complete a full assets register or just to calculate certain information. AAT tend to present the non-current assets register in a particular way, but this may be different from what you might be used to at work. So make sure that you're clear what each of the columns represents in the exam and which boxes you're expected to fill in. Make sure you move your cursor over all the boxes and make sure that you put an entry in if there isn't a no entry sign that comes up. If the answer is 0, then enter 0.00. Don't leave any boxes blank. If you get a full register to complete, there's likely to be quite a lot of information given in the preceding question, so use the references option to split the screen to make it easier, so you're not having to scroll up and down all the time. You might be asked to make entries into the asset register, and if you are, it's likely you'll be presented with an invoice with a number of items shown on it. It's important that you look carefully at these items, as there may well be more than one thing which is part of one actual item. For instance, a printer with a stand or a piece of machinery with a safety cover, and in that case you'd have to add the two together. Equally, there might be items which are revenue and can't be included, such as some printer cartridges or paper, or maybe some goggles or gloves. Always check the instructions for the minimum level of capitalisation according to the materiality policy, as you might also find an item which you might think is capital, such as some tools, but in fact these are below the minimum level, so they would in fact be treated as revenue items. When an item's been disposed of during the year, even on the last day of the year, the carrying amount will always be 0. The depreciation charge for a disposal will be 0 if the policy is that no depreciation is charged in the year of disposal. But if the policy is that depreciation is charged monthly, then you may well have some depreciation charge in the year of disposal. So again, look at those criteria carefully. Make sure that all remaining assets have been depreciated according to the correct method, as there will often be 2 different methods given for different types of assets. There are often short answer questions that test your ability to identify the effect of errors within the accounting system. Now, don't just expect to be able to answer these straight off. You'll probably have to model them through on your scrap paper to test out your assumptions. You could be asked to say what the effect of errors in the classification of revenue and capital expenditure might have on the final accounts. For instance, on net or gross profit, on the current or non-current assets, or the current or non-current liabilities. In general, the purchase of a capital asset does not affect profit at the time of purchase, but the depreciation of the asset will create an expense that reduces profit throughout the useful life of that asset. If the purchase of a capital asset is wrongly classified as revenue, it will reduce profit immediately for that year, as expenses will be higher than they should be, which will look bad in the accounts. So, in summary, generally our students do well on this question, but this is only the case because they've worked hard and revised thoroughly. Tasks can contain a lot of background information and rules, so take your time and use scrap paper or split the screen in the exam to make it easier to follow. There is a lot of content to learn, and this is covered in a number of lessons on Moodle with lots of great examples to work through. Good luck!